Hi, I'm Midas and welcome to the quarterly market update. In this video, we're going to go over the overall returns of capital markets, both equity and bond markets, talking about equities here in the United States as well as internationally, and also going into general returns dispersed by different sectors. And then we're also going to talk about my own portfolio and how it did during the quarter and its overall positioning for the next one. This is the third video in our series covering quarterly market updates that we're going to be trying to do regularly. But it is going to be a little bit cut short relative to the previous two, where I covered a few more specific details. So it's a little bit less information in this one. But either way, I wanted to make sure I got it out, especially so that we can have my own returns on the record going forward. But if you're new to the series or to this channel, you might want to check out the first two videos and also subscribe to the channel. That way you get notifications whenever I go live or release other videos like this, and also like the video so that the algorithm will push the video to other viewers. So at the end of the second quarter, I definitely didn't have super high hopes for the third quarter, but nonetheless, the third quarter was an interesting ride. As far as the interest rates go, which was a main focus of our discussions in the last two videos, you can see the overall returns on Treasury yields, regardless of maturity, has been pretty bad overall, whether it's the 2-year, the 10-year, or the 3-month, the only one being the exception, obviously being the tips in this year of high unexpected inflation, as the yields have been moving up pretty precipitously. We had discussed in the second quarter how you can see that it was pretty flat there in between the first and second quarter, and then we finally moved up another leg as far as interest rates go and the overall yields this quarter, causing equity prices to be pushed down a little bit more. And in general, we can also look beyond the treasury yields to the overall corporate yields, seeing the same thing here. It's high grade yields as well as investment grade yields, emerging market yields, both high grade and high yield across the board. Corporates have moved upward in the yields following the treasuries, and then the overall returns of said bond markets have moved down in general. So while the equity markets have been a pretty bad place to park your money throughout the year, it turns out parking your other money in bonds has been a pretty bad place as well. As bad as inflation has been, cash has been, relatively speaking, one of the safer places to hold your money so far this year. And coming into this particular slide, which we've covered a few times in our previous videos, I like to disaggregate different elements of the bond yields according to different indices to kind of get an estimate of different premiums associated with different aspects of the market. Starting with the bottom, we have the real risk-free rate, which is effectively the portion of the yield that's a portion to be thought of as a real return after adjusting for inflation and also adjusting for general risk. And then on top of that, we have the expected inflation, which, as you can see, is generally moved up over the course of the year, though it's relatively still low. This is a 5-year expected inflation approximately. And then the time premium, as we had discussed in previous videos, effectively had disappeared, as you can see, which is what they refer to as the flattening of the yield curve and the inversion of it. And it's only become more inverted in the third quarter relative to where it was in the first two quarters. And then beyond that, you can see a lower risk and a higher risk bond premium, and then an emerging market premium on top of that. And in general, all three of those have just been moving up along with the increase in yields. And enough of talking about the bond market, moving on to the general equity markets. You can see our main indice that we generally like to compare ourselves to being the S&P 500, but we also like to look at the rest of equities as dispersed according to 4 other markets, being the Russell 2000, which is representative of small caps in the United States, and then developed markets and emerging markets, as well as a foreign small cap indice, the 5 of which altogether effectively shows the 99% of all the equity returns in the global markets. And you can see, while yes, the S&P 500 is actually still leading the pack at the end of this third quarter, when it was relatively near the bottom of the pack at the end of the second quarter. So it's pretty interesting to see that flip. But in general, all of the markets did roughly the same thing, which is since the bottom of the last quarter, they've kind of moved up towards a little bit of a bounce back, and then they all moved back down to relatively new lows at the end of the quarter. Taking a look at volatility as it's expressed both through the VIX, which is an implied volatility index, as well as the put to call ratio, to kind of get an idea of the general ratio between different derivative markets measurements of volatility. And you can see that in the earlier part of the year, in the first and second quarter, there was a little bit of a disbursement between the two, where you can see the VIX and the put to call ratio moving not entirely in sync, but in general there was still an in sync movement upward and downward. And in general, over the course of the year, you can see that they have slowly moved upward, both of them, in terms of the average placement of both of them. But the other thing that's interesting that I thought of note is that in this here third quarter, you can see that they started to move a little bit more in sync relative to where they were in the first quarter, which I think is in general the sign that the markets are just seeing higher volatility for the longer term. but it's also worth note that the absolute value of the VIX and the put to call ratio are getting to pretty elevated levels. It'd be pretty interesting if we can get that average put to call ratio up to 1 itself, so that there's one put contract for each one call contract. So taking a closer look at the equity markets and disaggregating specifically the U.S. equity markets down by different sectors. Obviously, you can see right here the clear winner that we've discussed through the previous videos being that the energy markets obviously have generally been the winner this year in the equities. But at the end of the second quarter, it had been at the bottom or relatively close to the bottom of that trough in the correction of the energy markets, and so it was a lot of people were saying that they were going to fall all the way back down, probably into net negatives by the end of the year. But it's interesting to see that when we had that bounce back up in the middle of the third quarter before it came back down again, it looks like energy had a higher spike than the rest of them. So while you might have thought of that as the equity markets making a bounce back, it wasn't a bounce back at the expense of the energy markets, which a lot of people are seeing an eventual decline in the energy markets as a support for the rest of the equity markets itself. So really, I see that as more of a general volatility bounce back more than an actual correction for fundamentals in any sort of sense. But it also is pretty interesting kind of just looking at the general disbursement of it, because obviously these were all moving pretty closely together other than energy for the first two quarters. But now the distance between the returns aggregated by sectors is really starting to show its distance as the year gets closer towards the end. For example, obviously you can see the huge difference between the staples, which is the highest returning of the sectors, not counting energy, relative to communication, which is the lowest returning. You see there's a much wider margin now than there was previously. So getting into the returns for my own portfolio, it was definitely a pretty disappointing quarter relative to my own hopes and expectations at the end of the second quarter. The second quarter, I had said that I had also underperformed the market relative to what I would have hoped. But this particular quarter, it was worse than that. I had barely underperformed the quarter in the second quarter, and now it's a much more significant underperformance. However, I do think I've done a good job of positioning myself for the future, so that is what it is. And part of that was recognition of previous mistakes from several quarters ago into last year. So anyway, at the end of the second quarter, we had a return of negative 17% relative to approximately negative 16% in the S&P. The S&P did negative 5% or so this quarter, and I did negative 11%. So definitely not very satisfactory at all. The cumulative overall COGR for my portfolio since inception at the end of the second quarter was 10.78%, and that's dropped to 5.31%. So the cumulative per year return got cut in half in the quarter effectively by that underperformance, which brought my expected 5-year COGR for the future is actually come down since then. At the end of the second quarter, it was at 19.89, and now it's at 16.07. So what that means is that I had high expectations at the end of the second quarter, and I've trimmed back my expectations even though my portfolio has come down, which generally you would see expectations move up if your portfolio moves down. What that means is that I actually readjusted my expectations pretty significantly to account for what I'm saying is effectively mistakes that I made in the past. And so we've readjusted, become a little bit more conservative in our approach towards our own expectations in trying to position ourselves better for the future. So, is what it is. You have to recognize mistakes at some points. So comparing those overall factors, I already talked about the actual quarter return already, but the benchmark COGR of the portfolio at the end of the second quarter was 12.78. So I was kind of trailing the S&P by about 2% per year at the end of the second quarter. And now they're at 9.22%, which dropped as well, but not as much as I did. And so that means now I'm trailing the S&P by 3.75% per year or so. So definitely huge underperformance, not what we like to see. But if you can bounce down that significantly in one quarter, it also generally means that you could probably bounce back pretty significantly as well. The expected COGR I had for the S&P 500 at the end of the second quarter was 8.8%. And that one I didn't have to recognize mistakes for. So that one went in the direction that it logically would given the movement of the markets. Expected COGR is now up to 9.67%. That's due to both changes in the earnings expectations due to analysts, as well as the overall discount rate changes with the rise in interest rates. The return ratio went from 0.84 to 0.58. That's the return of my cumulative COGR relative to the benchmark COGR, saying that per year returns, what ratio of the returns am I earning? So I was a little over 3/4 of the returns of the S&P. I was where I was at the end of the second quarter. Now we've dropped to less than 2/3, more than 1/2, less than 2/3. So definitely not what we'd like to see. So taking a look at my returns in the longer term, since inception of my portfolio, on the left, you can see the overall cumulative return of my portfolio relative to the total return index in red, blue being mine, red in there. And then when it branches off into the orange, that's when I started actually keeping track of a different type of data that I didn't have previously, which is the dollar weighted cumulative return for the total S&P relative to my own portfolio. So if I had made the same deposits in the S&P at the same time, so you can get a more accurate reflection of my portfolio relative to the total return. So effectively what should be looked at there on the left is the blue versus the orange, effectively speaking. Either way, you can see we have been underperforming for quite some time, and the underperformance continues, as we've kind of talked about. And then on the right hand side, it's effectively the same information, but we've turned it from a cumulative return into a yearly COGR return on a kind of rolling moving basis or so. And then because we did that, that means I kind of needed to do the same thing of forking off from my own portfolio into the darker blue, which means that at the end of the graph, you should be looking at the orange and the darker blue. Those are the two lines that are most apples to apples comparison for that, a dollar weighted compounded annual return for both my portfolio and the benchmark S&P 500 total return index. Either way, like I said, underperformance in the last year or two. So taking a look at what my portfolio actually looks like at the end of the second quarter compared to now, we had 25 total positions at the end of the second quarter, and we are now down to 23 positions. So we've netted out a couple of the positions. The overall concentration has actually barely moved between that time frame. Ending cash position at the end of the second quarter, I was at about 12%, and we're still at really relatively about 12% for the overall cash, but down technically a little bit amount. And that's relative to the overall average cash position during the quarter, which I like to include because my cash movement does move pretty dynamically through the quarter at different points. And so the ending cash position isn't necessarily as very representative of what the cash position was like throughout the whole quarter. So I like to include that. The average cash position for the second quarter was 5.5% or so versus just under 12% for the current quarter. So there wasn't that big of a difference for the current quarter. Cash target, however, on the other hand, at the end of the second quarter, I had a relatively high cash target of 17.7%, and it's now down to just under 15%. So either way, we have less cash than we would like to have, effectively speaking, but you can see that our target for cash has actually moved down in the quarter as well, which is what you would expect if the market's moving down, is that I'm going to start targeting less cash because we should start moving the cash in. Also taking a look at my beta, which is a weekly 2-year beta of returns that I do of my own portfolio against the S&P 500 to get an idea of just how much I'm moving with the market. At the end of the second quarter, it was 0.67, and at the end of the current quarter, it's 0.7. And taking that beta and the calculation that I do thereof of it, I include the summary statistics here and my kind of information relative to it, which I know a lot of people aren't very big fans of the CAPM model. But even if you disagree with efficient market hypothesis, which I definitely do, and don't necessarily agree with CAPM as a general basis for portfolio management, which I also definitely don't, that doesn't mean there isn't lots of useful statistical information you can get from taking a look at beta and the equivalent alpha, or as it is known by the Jensen's alpha, and the calculation thereof, which is basically saying if you take the beta of your portfolio, you can get an idea of what percentage of the returns according to the CAPM model you would have gotten relative to the S&P 500 given the general positioning of your portfolio, and that can give you an idea of basically how much of the returns are supposedly according to your own skill, though there's other models that would like to account for different things. Like, for example, at the end of the second quarter, I showed that I had a significant excess amount of returns. Even though I'm undershooting the S&P 500 in total returns, I'm doing more than the CAPM model says I should do relative to my volatility and relative to the overall returns of the S&P 500. In this quarter, that actually did shoot down pretty significantly because, like I said, I did shoot what I would have hoped to have gotten in returns this quarter pretty significantly. So that annualized alpha amount went from positive, I think it was like 5 or 6% or something per year, to now negative almost 1%. As you can see right there, that negative 0.95 is the annualized amount of the alpha expectations that I would have. So my beta is now 0.7. Like I said, my beta moved up significantly in this quarter, and it's actually a relatively uncertain interval beta. My beta calculation is actually somewhere between 0.66 and 0.75, but the point estimate is 0.7. And effectively speaking, I earned 1% less returns per year over the last 2 years than you would have expected me to have relative to the CAPM model. So not only am I undershooting in absolute terms, but I'm undershooting in statistical expectation terms now at the end of this quarter. But like I said, last quarter, it was the other way around. So these things can flip back and forth pretty quickly. So in previous versions of this video, I also included my top 5 positions and went over some of the details of it, but that's one of the things I'm kind of going to be skipping in this particular iteration of the video. I'll do that again in the future, but I kind of just wanted to get this video out relatively quickly because I knew I was kind of running behind on that. But either way, this is the cost weight of my portfolio, which is the way that I like to think about the positions in my portfolio. I consider something my number one position based off of the amount of money I've put into the position off of cost basis, not off of the actual position that the holding has in market weight. So this is representative of how I think of my portfolio in order. You can see right there my cash position as it currently was only a day ago. So not necessarily at the end of the quarter. This is reflective as it is relatively right now. So it is a little bit 2 weeks off. You can see my number one position of Fidelity National Financial hasn't changed. Coursera hasn't changed. There's a few of the changes in my top 5 positions that have moved over the quarter, but you can see a general idea of my positions right here. Though it's worth noting, not every slice is labeled. So if you're wondering if there's something in there, maybe it's just kind of not necessarily pointed out specifically in that particular detail. And this is that same graph, but now it's reflective of the actual market weights. We keep the slices in the exact same positions so that you can see, not necessarily get confused on the positioning of the different slices, but now the sizes of the slices is reflective of the market weight. So you can see basically the gains or the current losses that are not being cashed on in the positions as it currently is. For example, the Fidelity slice is now much larger than it was in the other picture, versus, like, for example, the Turtle Beach slice is significantly smaller in this slice than the other one, showing that I have gains in Fidelity National Financial and I have losses in Turtle Beach, though, like I said, they're not realized in either case. So that's going to do it for the quarterly market update. As I said, we kind of skipped over a few of the categories of discussion that we have talked about in previous iterations of the video, that being the commodity markets and the currency markets, as well as those specific details on my top 5 positions that I'll probably include in later versions of the video. If you made it to the end of this, thanks for watching, and please give the video a like. And if you're not already subscribed to the channel, please subscribe to the channel. That way you get notifications when I release other videos like this, or whenever I go live with one of my live evaluations. And also, if you are already a subscriber to the channel and want other forms of content related to me and my community, you can join the Discord, the link to which will be in the description below. So come join the community and be part of the discussion there.